Hi, and welcome to the November MENA market briefing. My name is Timothy Francis, and I'm joined on this occasion by my colleague Abhishek Kumar. In this episode, we are going to take a look at OPEC policy and October's 444,000 barrel per day production deficit from West Africa. Then in the second half of the session, we will examine the missing piece of the demand puzzle. Abhishek will share some highlights from an extensive special report that we recently published on jet fuel markets. So stay with us. Crude prices had a strong month through October. The candlestick chart shows Brent futures broke the $80 resistance level, trended up towards 87 before a sharp pullback ahead of the OPEC Plus meeting in early November. And prices remain well supported above the $80 level, although the recent commitment of traders print shows that speculators had in fact trimmed long positions slightly, in Brent at least, possibly as traders look to book some profits. The US benchmark has actually performed even better. If we look at the WTI Brent spread in the purple line, that shows the US benchmark has been very strong indeed, narrowing its discount to as little as 76 cents against Brent in late October, although that spread has now widened to a more familiar territory of around $2.50. Turning to Asia, the Brent Dubai EFS has continued to widen even beyond $5 per barrel. And I had to scroll back all the way to June 2014, 7 years ago, in order to find an equivocal high. So that just shows the strength of Brent relative to Dubai. Last month, we actually highlighted the possibility that an imbalance in returning OPEC crude production, which favors the Middle East, could indeed weigh on the relative price of the Asian benchmark. However, it would appear that the struggle of key West African producers to raise production is a more critical factor in the benchmark spreads. And we're going to take a closer look at that now. So OPEC Plus, they did in fact resist calls from US President Joe Biden to accelerate production increases at the monthly meeting on Thursday, November the 4th. The exports group will proceed to add 400,000 barrels per day back to production in December, and they'll continue along those lines as per policy until the quotas actually finally reach baseline levels. The data here shows the Middle East producers are effectively fulfilling those quotas. October compliance levels for adjusted production quotas, that is, shows Saudi and Kuwait at 102%, Iraq at 100%, and UAE at 99%. However, if we look at the West African producers, Nigeria and Angola, compliance levels are way off. We're at 191% for Nigeria and 259% for Angola. Now, we did point this out in last month's session, but this consistent underperformance is now leaving quite a significant gap in global supply. Here we have production and export data for Angola. The Reuters poll data on the left-hand chart, that indicates that total crude production hit 1.1 million barrels per day in October, compared to a production baseline of 1.53 million barrels per day. Now, what is concerning for Angola and for oil importers generally is that total production is continuing to decline when it should in fact be ticking upwards. In October, Angola was permitted to pump 1.36 million barrels per day, but actually only pumped 1.1 million barrels per day. And that accounts for a 263,000 barrels per day in missing OPEC production. Turning to the Refinitiv export data on the right-hand chart here, the numbers correspond closely to total production estimates. And with regards to the direction of flows, the vast majority of Angolan crude actually sails east to Asia, with Chinese companies dominating term supplies. The Americas and Europe, they only take a small fraction of total export volumes as per the data here. But for the last 3 months, it would appear that those markets, regional markets, are starting to feel the pinch of lost barrels. And that would certainly be supportive of wider Brent Dubai EFS we mentioned earlier. Nigerian data, that tells a similar story. In October, Nigerian operators pumped an estimated 1.45 million barrels per day versus an adjusted OPEC allowance of 1.63 million barrels per day. And that accounts for an estimated 181,000 barrels per day in unused OPEC quota. Our flows data confirms the drop in volumes that are hitting the seaborne market. And in the case for Nigeria, which is pretty dynamic, I suppose, in terms of trading patterns, it becomes a little trickier to determine the impact on regional supplies and distribution of those barrels, although it would appear that US buying is the most likely to be impacted from falling output. At this point, we have to ask why the West African exporters are not raising production at a time when there is ample incentive to do so. Prices are at their highest level in 7 years. Light sweet barrels linked to Brent, they're in high demand, and the global market is undersupplied, which means that additional barrels are unlikely to have a negative impact on global prices and therefore revenues. So that scenario implies that producers are actually unable to raise production, and underinvestment over the past 7 years appears to be the most likely culprit for that. In Nigeria, for example, the IOCs have sold onshore assets due to the operational difficulties or headwinds, you might say, particularly related to security risks, while higher cost offshore operations, they may have been neglected through the years due to low prices and alternative priorities, certainly within the capital markets. So this is a critical issue because it essentially means that these producers may not actually be able to supply more barrels to market in the short term anyway. And that's at a time when demand is really ripping higher. This is obviously adding fuel to the fire for short-term oil prices and price bulls. These charts, they plot the EIA's global supply and demand forecast for September and October. Bear in mind, the next report is out or due out very, very soon. For the fourth quarter of 2021, the agency actually decreased its global supply forecast or estimate from 200,000 barrels per day or a 200 KBD deficit to an 800 KBD deficit, which is clearly not a very significant, or it's not an insignificant revision. Now that correction came from 210 KBD increase in global demand and a 450 KBD decrease in global supply estimates, which obviously align quite nicely with the numbers we're seeing in West Africa at the moment. Now, the EIA, they're not alone in their revisions. Most analysts have been revising up their price projections in recent months, and the market, seems to consistently overestimate supply and underestimate demand. But having discussed the supply picture, I think we're going to take the opportunity now to turn to the demand side, and specifically the jet fuel markets, which has been the missing component of global recovery to date. And Abhishek's been involved in producing and authoring a special report on this, which is now available, and he's going to kindly share a few highlights from that report with us now. So Abhishek, why don't you take it from here?
Thank you, Tim. So as Tim mentioned, we have recently published Global Jet Report, which discusses east and west of Suez market in detail and what to expect next. So just to get the perspective how big the impact was due to COVID, global GDP contracted 3.5% in 2020, which is lowest since Second World War. And before COVID, the same global GDP was projected to be 3.4%. So a total relative loss of 7%. And COVID has impacted almost all businesses, but airline industry has been one of the worst hit sectors. And with skepticism around traveling, passenger segment of the aviation industry came close to a standstill at one point. Revenue passenger kilometers, which is a measure of traffic for airline, came crashing by more than 94% year on year in April, a rate never seen in the last 3 decades. As a result, jet fuel was the most affected amongst other refined product and continues to be so to this day, though the intensity has tapered off. In West of Suez, Americas account for a third of global jet fuel demand, of which the United States account for the bulk of it. US jet fuel demand reached a historical peak of over 1.8 million barrel per day in 2018 and 19, before the pandemic brought the entire aviation sector to a standstill, with demand dropping to a historical low of 600 kbd in May 2020. Considering demand and a return to its highs, the US experienced only a slight increase on average during the summer months. For 2021, the seasonal trend has been seen to touch the lower end of the pre-COVID spectrum since July, albeit at a lower level than we would have expected. Also, US jet fuel demand is very concentrated in only a few states. Coastal states that service international flights sees the most of the jet fuel demand. And US's jet fuel demand is expected to improve with resumption of flights and as vaccinations picks up. However, EIA has cut its 2022 outlook for US jet fuel demand by 80 kbd to 1.6 million barrel per day. In Europe, import has picked up pace over the summer months, buoyed by the implementation of EU digital COVID certificate in July, which allowed vaccinated citizens to travel within Europe without quarantining. A Refinitiv tracked a doubling of seaborne import compared to July 2020. The majority of the 1.2 million metric ton of arrivals originated from the Middle East. IEA has estimated 345 kbd increase in quarterly demand during Q3 to average 1 million barrel per day in OECD Europe, around 730 kbd below pre-COVID levels. IEA had also forecasted a small increase in demand over the remainder of the year, although the sustained imports and changes to US travel restriction points to a stronger demand recovery over Q4. Now moving to the supply centers in east of Suez, Asia Pacific is the top exporter of jet kero in the world, with yearly volumes averaging around 32.7 million metric ton between 2017 and 19. But in 2020, the exports were just 70% of that average. In terms of major contributors to the export, South Korea, Japan, China, Singapore, and India are typically the top five and account for more than 90% of the regional outflows. The market structure is in backwardation and particularly steep along the Jan-Feb spread when jet kero demand is expected to be at its strongest. We believe this indicates that not only the traders and end users confident about demand in the prompt before winter, but also indicates that airlines have been actively taking position in the forward market and locking in their hedges. Also, an anticipated surge in US demand ahead of the Thanksgiving and Christmas holidays is also expected to draw barrels from South Korea, lending more support to cash differential. From demand side, there are a couple of factors which are at play and all combined will decide the way forward. Generally, in last quarter of the year, we start to see the stockpiling of kerosene on the back of heating demand for winters in North Asia. And as per the latest data, there is a likelihood of a tame winter in Japan, the single largest regional consumer of kerosene as a heating oil. Along with this, China has imposed a consumption tax on light cycle oil, which is typically blended with kerosene to produce 500 ppm sulfur diesel, and that has kind of a knock-on effect on the aviation fuel. The third factor is the pickup in travel demand, and Asian aviation market is showing signs of recovery ahead of the year-end festive season. And even Asia's vaccination rate has finally begun to outpace the global average, with 54% of the population having received at least one dose of the vaccine. Coming to the region Middle East, which is a major supplier of jet fuel to Europe, close to 50% of the continent's import volume is catered by Middle East. In Middle East, Saudi Arabia, UAE, and Kuwait are the top three exporters of jet kero. Saudi Arabia is the largest jet fuel producer, followed by UAE and Kuwait. And these three countries together account for more than 75% of the total regional outflows. And one thing about Middle East is that even before the pandemic really started to have a global impact, Middle East exports were lower in first quarter of 2020. The reason is the region saw planned offline capacity crossing 1.2 million barrel per day. Although this had little to do with the loss of jet fuel demand at that time, with jet fuel being the straight-run product, the CDU downtime has a direct impact on the production volume. But as refineries in the region started returning from maintenance, jet kero export started to improve. Soon, in the absence of real demand of jet fuel, the imported volumes into Europe ended up in storage, which in turn swelled up both the floating as well as inland storage. and outflows again started to slow down before picking up again in Q3 of 2020 as air travel gradually started. In terms of jet fuel demand in the region, the UAE and Middle East uh, is the biggest jet fuel market, accounting for roughly 30% of regional demand, followed by Saudi Arabia and Qatar. Middle Eastern airlines dependence on connecting international flight and the lack of large domestic market delays the recovery in the region. However, with more easing and travel restriction and major events lined up, consumption is expected to improve. In terms of numbers, Dubai, the busiest airport for international passengers, saw a decline of 70% from pre-pandemic level in 2020. But in 2021, first half, the traffic was close to 10 million. And in just last quarter of this year, the numbers are expected to be close to 7 million. And thanks to events such as Expo 2020 and Air Show, which are lined up for the months ahead. And Saudi and Qatar are also expected to see the growth. Saudi recently announced that airports in the country will operate at full capacity, and we do see gradual pickup in domestic demand in the kingdom. For Qatar, FIFA World Cup will be the booster shot, and recently Qatar has also signed a comprehensive air transport agreement with the European Union. With this, Qatari national carrier will be allowed to enter European market easily and expand its network in EU countries without limits to payloads or number of flights, which in turn will have positive impact on jet demand. However, EU airports in Belgium, Italy, France, Germany, and the Netherlands will be subject to a gradual build-up to capacity until 2024. So summarizing on what we discussed, jet cargo demand is definitely expected to pick up, but yes, the demand recovery will not be even across the continents as vaccine rollout is not equitably distributed around the world, and developed nations have vaccinated their population far faster than less developed countries. Another factor to look out for is increase in COVID cases in Europe. However, the hospitalization rate is not high, and we don't expect harsh measures as a complete lockdown. And in recent development, Pfizer has announced that its experimental antiviral pill for COVID-19 cut rates of hospitalization and death by nearly 90% in high-risk adults. Though vaccination remains the major response to tackle the infection, easy-to-use treatments will be critical to curbing future waves of infection, which in turn is healthy for aviation sector and jet fuel in particular. Yeah, thank you. Over to you, Tim.
That's great. Thanks so much, Abhishek. Yeah. So just to conclude the session really with a few thoughts and a recap, I suppose. You know, it appears the spectre of another COVID wave is ever present, and but markets, you know, they continually seem to shrug off any concerns around new waves and developments, and that seems now to be compounded by some of the optimism we're now seeing within the travel sector, which has the potential to boost global oil demand quite significantly over the next few months, as Abhishek's pointed out there. So the market, I think, at this point could easily find itself in a scenario whereby demand recovery accelerates even further than already anticipated, and supply deficits, continues to deepen potentially. That 444 KBD gap we discussed in OPEC production created by the West African exporters doesn't really appear to be going away anytime soon, that's for sure. And that may in fact only widen as monthly production ceilings slowly increase. West Africa producers, you know, they're not alone in this either. Other OPEC Plus members may not necessarily have the flexibility to raise production as they might like as well. Therefore, the pressure may mount on other OPEC members, particularly those in the Middle East, to accelerate production increases come the December meeting. So until then, I would encourage everybody to read the Jet Fuel Report if you haven't already, and join us again for the next session in December. We look forward to it.